Hello, I'm Attorney Louis Haskell, and I am at the Red Water Lily Farm in Nakhon Nayok, Thailand. And as you can see, the water lilies are starting to open up today, this morning finally. It was cold this morning, so they were a little slow getting going. And I want to talk today about some of the provisions in the new tax law that relate to small businesses. So-called pass-through entities, because this is, to me, perhaps the most important change in the tax law. It's the one that could potentially have the biggest impact on me personally. It actually creates some opportunities for people to be thinking about their legal form of their business, which is always fun for me. But also, it's just where the most money seems to be involved outside of the corporate sector. In other words, on the individual side, there's a lot of moving parts. A lot of people will get tax cuts. I'm not sure how big they are. Here I know exactly how big. The thrust of the new law is that for so-called pass-through entities, they can exclude up to 20% of their taxable profit from their individual tax returns. So if a business makes $100,000, whereas under the old law you would be taxed on $100,000, now your tax liability would be reduced to $80,000 because 20%, in this case $20,000, is excluded. And pass-through entity is really quite broadly defined. S corporations, LLCs, partnerships, some trusts and estates, and even sole proprietorships. People who are simply filing their taxes on a Schedule C are considered pass-through entities for the purposes of this discussion. So pretty much all small businesses are included in this. There are, however, exceptions. The most brutal one, especially for people like me, is the exclusion of what I call personal services businesses. And that specifically includes lawyers and accountants. It would include hairdressers, manicurists. It would include athletes and actors. Most business consultants, or really pretty much all consultants in general. Interesting enough, architects and engineers manage to get themselves excluded from this definition. But for a lot of us, it sets a cap on how much we can make. And basically that is, for a single person, $155,000 of taxable income. For a joint filer, $315,000 of taxable income. After that, that 20% exclusion begins to phase out. For a married couple at $415,000, I believe, it's completely gone. So if you're a particularly successful accountant or lawyer, it hits athletes and actors and actresses really hard. If you're particularly successful in these things, you lose this benefit. But for a lot of folks, this 20% write-off is quite nice. For those outside of the personal services realm, there's a second limitation, and that is your 20% exclusion is capped, well, for most businesses at 50% of their payroll. So if I were not a personal service business, for example, this would not be a problem because my payroll is usually more than my profit. Actually, I think it's pretty much always more than my profit. So 50% of my payroll would be more than 20% of my profit, so I'd be okay. Where this 50% of payroll can be a huge problem, however, is for real estate businesses. My wife and I have 16 Pine Street, and 16 Pine Street has no payroll, and yet this new law is designed to cover 16 Pine Street as well. And so there is a second way to calculate the cap.